Hello and welcome to Portfolio Matters, weekly update, week 68. And it's been a volatile week in the markets. But before we get going, first of all, can I just wish Her Majesty the Queen a happy Jubilee. We are big fans of the Queen on this podcast, and she has to put up with a lot. But anyway, before we get into it, Richard will read this disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Well, another busy week in the markets, but before we get going, a reminder, pub night on Wednesday, the 11th of May, different pub, one where we can spill out onto the street and enjoy the good weather, he says, fingers crossed. So hope to see you there. Okay, this week, the news was, first of all, Indonesia banned palm oil exports to protect domestic prices. And frankly, as commodity prices rise, and particularly food prices rise, I think you're going to see increased resource nationalism. And of course, that is going to mean that there's less oil on the international markets and will push up the price of cooking oil. We have a chart for you later. Lockdowns sadly continue in China and don't seem to be getting better. And that is going to cause renewed supply chain difficulties. Elon Musk has bought Netflix. Equity markets had a big sell-off, but have bounced back a bit in the last couple of days over fears for Q1 earnings. But then Facebook beat earnings expectations. The earnings themselves were pretty poor, actually, but they beat lowered expectations, and that has caused a bit of a bounce. We wonder whether Wall Street is now playing this game of talking down earnings to the extent they can be beaten, even though the earnings themselves aren't great. And in Europe, Gazprom has cut off gas supplies to Poland and Bulgaria because they refused to pay in rubles. And European gas prices spiked, but have seemed to have subsided a bit. We'll show you the graph later. And finally, the US on Thursday passed a Lend-Lease Act that you'll remember there was Lend-Lease during the Second World War, which allowed Britain to buy arms from the US with loans. And I believe that's what they're intending to do for Ukraine. So that will increase the supply of arms to Ukraine, but potentially lengthen the war. And there's the danger of escalation. So this is a chart showing Indonesia's share of world palm oil exports, and it's big. It's about a third. So them cutting off supplies will have a big effect on cooking oil prices, and which shot up this week. And lockdown continues in Shanghai. They're now putting cages around apartment block entrances to stop you getting out. And last week's sell-off in equities also coincided with the largest ever fall in Fed reserves. Is that a coincidence, we ask ourselves? This is the Twitter share price. Elon Musk has bought it for $46.5 billion. Profits last year for Twitter were minus 221 million.
There's a man who's got too much money.
Well, I think he's going to have less of it, Richard. Okay, moving on to economic data. So EU services PMIs came in better than expected. So they're expected to fall slightly from March levels, but the April number actually showed a decent beat. It was expected at 55. It came in at 57.7. So Europe is doing better than expected. In the UK, though, there was a miss. So UK services PMIs was expected to fall from March levels, which it did, but it fell worse than expectations. So it came in at 58.3, expectations were 58.9. In the US, there was a big miss. So services PMI was expected to fall slightly from March levels, and it fell quite sharply. It fell to 54.7. It was expected at 57. Now, the Case-Shiller House Price Index in the US continues to beat expectations. We had numbers for February this week, and that showed that annual house price inflation was running at 20.2%, above expectations. And we have another section on the US housing market this week. And finally, the big number of the week was US GDP for Q1, which was a big miss. So it was expected to be positive 1.1% annualized, and it actually came in at minus 1.4%. But we will show you the breakdown of that number in a second. Okay, so doing some charts. So this is the US GDP growth chart quarter on quarter, and you can see that actually negative quarters are quite rare. So, and we weren't expecting a negative quarter in Q1. So what's going on? Well, if you break it down, and we're looking at this first column on the left, you'll see that the whole of the miss can be attributed to essentially exports, a big drop in exports, and with also a negative contribution from government spending, which was expected to drop as all the stimulus measures start to roll off. So that would seem to indicate that the rise in the US dollar is having quite a negative effect on US exporters. The market is pricing in a 99% chance of a Fed 50 basis point rate rise next week. And the IMF has downgraded global growth forecasts after the Russian invasion, but you'll notice that apart from Russia, they're still expecting pretty solid GDP growth. Job vacancies in the UK are at a record high. Richard.
Yeah, thanks, Keith. So Germany, the composite PMI is moving along at around about its normal 55 or so. But EU manufacturing PMIs take a bit of a sharp dip, and this is probably due to the energy prices. So PMI is not following manufacturing PMI. Whether it will, does it tend to trail manufacturing PMI? Difficult to know, isn't it?
No, I'm quite impressed by this number actually, going in completely the opposite direction from expected.
And the composite PMI is pretty stable.
Yeah, resilient.
Yes. UK public sector borrowing. It got better from the pandemic, start of the pandemic. If you follow that line across, it's the worst it's been since early 2012 by the look of it, even now, which is not a good sign. The UK manufacturing PMI doesn't really look very healthy. 55 is a decent number, but the way the chart looks isn't great. And UK services PMI is looking much better and a little bit similar to European. And the composite US manufacturing PMI has leapt ahead in 2022. And the services PMI is looking less healthy. And composite is looking reasonably satisfactory, I would say. The house price index, and the question you have to ask this is, at what point is it going to stop going up? US new home sales still looking quite healthy. And the mortgage rate is, if you're about to borrow some money, it's looking far less healthy. And the question is, at what point will that impact house prices? activity in the US housing market.
And the speed with which that has risen has been absolutely shocking.
Initial jobless claims in the US are stable, as are continuing jobless claims.
Yeah, painting a picture of a decent US economy, really.
Yeah. The Spanish producer price inflation, how high can it go is the question after all, 47% nearly.
I can't see how the profit margins of European companies can't be squeezed by producer price inflation running at 46.6%.
I saw yesterday the ECB, probably Lagarde, or I didn't, but they came out and said that they expected European inflation rates to start dropping quite quickly, quite soon, which I think is a classic case of hoping to talk the market down.
Yeah. Notice they don't plan to do anything about it, Richard. They just plan to hope.
Minus 0.5% is still the appropriate interest rate.
Yeah.
Still doing QE. The US Federal Reserve balance sheet. And appears to have peaked, which presumably means the stock market has peaked.
You cynic.
The ECB balance sheet, however, has not peaked. And they are planning to continue to QE into the autumn.
Thank you, Richard. Okay, on to Inflation Watch. No new data this week because we have all the data for March and we are now awaiting data for April. Now, we did have flash harmonized consumer price inflation for Germany. And we report CPI, so we don't report the harmonized number. And that came in hotter than expected for April. And if that's a harbinger for the CPI number, then inflation is certainly still rising. And this is the expected path of Fed rate hikes over the coming year. Now, I just don't believe this. I think that the economy will slow before they can execute this plan. And US wages are rising fast, particularly for the low-paid workers. High-paid workers are getting inflation. High-paid workers are getting pay rises well below inflation, whereas low-paid workers, their wages are approaching inflation. And this is US M2. Over the last 3 years, the amount of money in the system, M2 is notes and coins plus bank deposits, has grown by 50.3%. Now, whenever it has grown more than 40%, a recession has followed because the inflation picks up and the Fed then has to raise rates sharply, which causes a recession. And in the Eurozone, you notice the divergence in inflation expectations. And so Lithuania is suffering from inflation of 15.6%, whereas in Malta, it's only 4.5%. The thing about the Eurozone is that the exchange rate can't adjust. So any adjustment in different costs between member nations has to take place in the real economy, i.e., exports from Lithuania become expensive compared to exports from Malta, and factories in Lithuania start to close and new ones start in Malta. That's the idea. Painful.
Just looking at Spain there, Keith, 9.8%. You do have to wonder what's going to happen to it when that 46.6% producer price inflation feeds through.
Yeah. And this is discretionary spending in the US in March. And you'll see that households have had to spend more on gas and housing, and they have cut back on recreation, airfares, alcohol, that's a bad decision. Furniture, hotels. So already US consumers are cutting back on their discretionary spending.
Moving on to Invasion Watch, we have our usual last week, this week charts, maps, and you can see there's very little difference between them. So although Russia has launched this much vaunted large offensive against Ukraine, the eastern part of Ukraine, I think apart from a few localized areas where they have focused their efforts, they haven't actually succeeded in making very much difference. And I think one of their problems is they're actually fighting a war on two fronts. They've got a line which is a front, and they're fighting in both directions because they're being attacked from the west and they're being attacked from the east. And if we just have a little look where we have supporting effort to southern axis, that effectively is Transnistria. And Russia is apparently mobilizing its forces in Transnistria in order to be able to invade Ukraine from the bottom western corner. If you have a look at the previous map, Keith. But the issue is, as Keith was pointing out to me a minute or two ago, how are Russia actually supplying Transnistria? Because they have no direct access to it. And that is an interesting question. But it does look to me as if we have the Russians stuck where they are. I'm sure they're causing a huge amount of damage, chaos, and a lot of deaths. But I do think they are probably bogged down. And the war may grind on for as long as Russia has the will to fight, particularly with the large quantities of Western arms that are being moved into Ukraine now, which will effectively, I think, ensure that Russia either has to withdraw or and effectively admit defeat, or try and hold the line against vast quantities of material that are going to start punishing them very heavily.
Okay, thank you, Richard. New section, Recession Watch. So I like this. I saw this. We do our own cycle clock, and Merrill Lynch also have one, and they have the clock actually just on the cusp between boom and slowdown. And that would mean their recommendation is to have your money in large cap equities, but be aiming to move into short-term treasuries or cash. And frankly, I agree. I think that is my next move, is it will be into cash. No, so potential recession indicators. Well, first of all, I saw this. This is heavy truck sales in the US. And you'll see whenever there's a big fall, that tends to forecast a recession. But we know there have been huge supply chain problems this time. So it may just be because there's a lack of availability of trucks. And US bankruptcy courts are busy. You see weekly bankruptcy filings have shot up, something to watch. And Nordea are forecasting a more pronounced slowdown in the second half based on 15 economic variables which they forecast. But bottom line, as yet, not really much sign of recession. Global PMIs remain resilient, as we have covered, and GDP growth forecasts remain positive. Okay, last week we tried and failed to be bullish, but this week we're going to try again. Why you shouldn't worry about Italian debt. Okay, so Italy is the second most indebted country in the world after Japan, I believe. And has a debt to GDP ratio of 150.8. So should we be worried about Italian debt levels? Particularly when the ECB has warned that from Q3, it will cease net new purchases of Eurozone government bonds, though it will continue to replace maturing bonds held on its balance sheet, and it will then begin gradually tightening monetary policy. And in the last couple of years, the countries of the periphery have not really had to pay market rates on their bond issuance because the ECB has bought the lot. So what's going to happen when the ECB stops buying all Italian bonds? Will there be a crisis? And this is a chart we showed last week. It shows that Italian bond yields have been rising and that the average interest rate on Italian debt was about 1.6%, we calculated. So if that starts to rise and they have debt to GDP of 150% of GDP, then their interest bill is going to rise sharply and potentially cause solvency issues in Italy. But why we don't need to worry? Well, first of all, for the first time in 15 years, the Italian government actually has a prime minister from the party that won the most seats. I found that amazing. And the government of Mario Draghi appears stable, competent, and has broad parliamentary support, which is, again, not something you can have said for the last 15 years. And high inflation is cutting the debt to GDP ratio. So nominal GDP growth is expected to be 10% this year, and that means the debt to GDP ratio should fall by 15%. Now you may see why the ECB is letting inflation rip. And the average interest rate on Italian bonds last year was below 2% and is expected to fall further as older, higher yielding bonds, which was issued years ago, are refinanced at lower rates. So actually its interest bill is likely to decline. And the EU have passed this Next Generation Reconstruction Fund, which will transfer the equivalent of 1% of Italian GDP to it over the next 3 years, and that will cut the deficit and hence the financing requirement. And finally, the average maturity of Italian government bonds is 7 years, so only a fraction needs to be refinanced each year. In conclusion, as long as GDP growth continues, particularly strong nominal GDP growth, Italy doesn't have a problem. But its very high debt to GDP ratio makes it vulnerable to a shock. If the economy turns down, then all those metrics deteriorate rapidly. Above all, if the ECB stops buying Italian bonds, all Italian bonds, then Italy becomes exposed to market rates again. And if it has an average bond maturity of 7 years, that still means it needs to refinance around 15% of its bonds in the market each year. So any loss of confidence could quickly lead to rising Italian yields and a solvency crisis. So watch this space. Okay, moving on. We have a special section in Japan from our special correspondent in Japan, Stuart Owen, who's currently on holiday there. And he sent us this picture. So this is what £4 buys you in a restaurant in Tokyo. A nice selection of sashimi there. Now, I tried and partially failed to find an equivalent in London, but here you go. What's that? About half as much, and that's £19.20. So for 5 times the price in London, you get half the sashimi. And Stuart commented that Japanese consumers have been used to zero inflation for 20 years and are very resistant to price rises. So restaurants find it very difficult to raise prices. But inflation is rising in Japan, and that means that Japanese bonds have negative real yields and are unattractive compared to much higher rates elsewhere in the world. So Japanese bonds are selling off, and the Bank of Japan tries to keep the yield of the 10-year in the range between minus 0.25% and plus 0.25%. And you can see here that the yield is approaching the upper limit. And the Bank of Japan has pledged to essentially maintain that upper limit through unlimited purchases of government bonds. And negative interest rates in Japan and unlimited QE means that the yen is selling off sharply, which will exacerbate inflation in Japan. And part of the sell-off in the yen can be attributed to the return of the carry trade. So you'll see here, the solid gray is asset managers' net purchases of yen futures, etc. So they are selling the yen, using the proceeds to buy US dollar assets where they receive a positive interest rate, a growing and positive interest rate. And their liability is the yen, where they're paying nothing, and the yen is selling off. So that was a very popular trade, in actually the 1990s, I believe. And it has returned, and that is going to exacerbate the fall in the yen. And the rise in energy prices in particular, bear in mind that Japan basically has no hydrocarbon assets, has to buy all its energy in international markets, means that it now runs a sizable trade deficit. So in the early 2000s, it ran a consistent trade surplus, and actually that has now flipped. It runs a trade deficit. So in order to balance the books, it needs to run a capital account surplus. But as we've just seen, negative interest rates and unlimited QE do not make it a very tempting investment location, and it's actually also seeing capital flight. All of that is going to be very bad for the yen.
And there's no particular catalyst for it to stop, is there? Because as long as the central bank of Japan holds interest rates at these very low levels, the yen is vulnerable, and it's going to be importing inflation, which will cause the yen to fall further.
Yes, absolutely.
So the danger is that they're in a vicious cycle, or they're getting themselves into one.
Yes, absolutely, Richard. They seem to be doubling down. Well, so they seem to be committed to this path.
Yeah.
So this week, Japan announced a supplementary budget of $21 billion to compensate households for rising prices and potentially fuel bills. And they're also talking about doing another additional budget in the autumn. So they're committed to further fiscal stimulus funded by debt issuance.
It does. It does smack of a Ponzi scheme, doesn't it?
Well, absolutely. So on this current path, Richard, as you said, it looks like the yen will continue to fall, which will cause rising inflation. And as people then start to sell all their JGBs because their real yield would become increasingly negative, then the Bank of Japan will have to buy increasing amounts of JGBs in the market to defend the rate using printed money, all of which is inflationary. And frankly, that is a hyperinflationary spiral.
It is. And the last point, Keith, we'll need to let Japanese government bond yields rise, which will cause itself solvency issues. Exactly. So the Japanese central bank owns so many JGBs that if yields rise, the price drops and the central bank becomes insolvent.
Yep. Watch this space.
So this is
occasionally we're meant to be bullish on this.
I was just say, so this is our bullish take on the Japanese economy. For the bear case, see you next week.
Conclusions. We've kind of done this already, but if you're interested, pause and take a look. Richard.
So a little bit now on UK office space. And the charts we got here are an extract from an FT article. And UK offices are currently operating about 1/4 of their capacity. And London is the light line. It's very similar actually throughout the UK. And what that means obviously is that there's 1/4 roughly of the city workers going into the city centres each day that there were, and all the businesses that revolve around servicing the use of office space will be struggling. And interestingly, there's an article today that the number of small businesses going into liquidation in the UK has hit a high, recently has hit a high, which suggests that the small business sector is really struggling. On Mondays and Fridays, people really don't like going to the office at all, particularly Fridays. And then Tuesday, Wednesday, Thursday, you hit a bit of a peak at 30%. Now, I work 1 day a week in a WeWork office in London, and I work on a Tuesday. And I noticed that the WeWork office is, I would say, about 1/4 full, and there are acres of empty offices there. So my personal observation is that this is absolutely, what this is saying is absolutely true. The rate of return to office has stalled, i.e. after it rose after the pandemic. It continued to go from pretty much zero up to around about 50%. And now there is no more increase in it. So it seems to have reached a plateau. Now, if you walk around London, there are still a lot of office buildings being finished. I don't know how many are being started, but if you're a building contractor and you're building a developer and you're building a large office space, even if you know you're not going to be able to let it, you are probably better off finishing it and incurring the cost of finishing it than you are in not finishing it and having an unfinished building to try and sell. But it doesn't bode well for either the UK construction sector, commercial construction sector, nor does it bode well for these developers who are developing expensive offices with no potential use, no potential occupancy. So I think that there's a seismic shift going on in the UK office sector, which is bound to, because building is such a large part of the economy, it's bound to have an impact on the economy. So our conclusion is that we've permanently changed working patterns as a consequence of the pandemic, and transport, services, and commercial real estate will all be affected by this. And I think the knock-on effects are going to take several years to come through, but they will be fairly significant. So what are the investment implications? So avoid commuter-related businesses, avoid sandwich shops, coffee shop chains, restaurant chains that may face these structurally lower revenues, and avoid commercial real estate, and avoid REITs because the value of their stock will drop and the income they receive from them will drop. For a change, we're going to cover the US housing market, which is looking strong. The red line at the top is year to date, and median sale price year to date, 17% year over year. And you can see that over the last 2 years, there has been a strong upward trend in sales prices, showing no signs of stopping. Asking prices are plateauing though, just beginning to plateau. The peak rise in the asking prices in each of the 2021 and 2020 also plateaued at around this point in the year. 2021 particularly obviously. So is it a seasonal effect, or is it something that is distinctive to 2022? Time will tell. So home buyers' mortgage rates have shot up 38% year over year. And this has to surely feed through into house prices and or demand. And pending sales are falling off. And interestingly, again, you see the same, roughly similar shape curve from 2020, 2021 and 2022. So again, it's hard to know. What we haven't got is any increase, but we don't know whether it's going to follow the same pattern yet. But I think there is possibly a sort of the early stages of change in the US housing market. And new homes listings are starting to decline over previous years. And again, it's not a huge difference, but there is potentially a change in the nature of that US housing market. This chart shows that houses are selling very quickly, with current median days of homes on the market before it's sold is 17 days. So there's clearly demand out there for houses. 54% are sold above list price, which is what you'd expect, I suppose, in the sense that we've got 20% roughly year-on-year house price increases, and the average home sold for 2.5% above the asking price. Again, suggesting there's a lot of demand, and only 3% of listings actually had to cut their price in order to sell. But the Redfin Home Buyer Demand Index is down 4% year over year, which suggests that demand is softening. So there's a little bit of contradiction in this data. So what's this table telling us, Keith?
So thank you to our American viewer, Herman, for sending me this. Essentially, you know the US housing market, the big Fannie Mae and Freddie Mac mortgage underwriters in the US are a key part of the home loan industry. Essentially, they provide guarantees for commercial banks in their mortgage lending. And what this shows is, if you look at the bottom row here, these are the premium they charge to underwrite second homes. And you'll see, essentially, they've massively increased the premiums. So you can't, if you want to buy a second home with a loan to value of above 80%, they're going to charge you a yield premium of 4.125%, i.e., they're telling you not to do it.
Yeah.
And they have explicitly stopped offering underwriting for high loan to value mortgage refinancing. So trying to stop people from taking more money out of their homes. So
the mortgage payment to income ratio is just about as high as it was in 2006, which we remember was where the housing crash. And National Mortgage News, Wells Fargo confirmed on Friday it's laying off an undisclosed number of home lending employees due to mortgage market conditions, a week after reporting a major decline in origination volume. And it's the third major mortgage payer this week to announce cuts in response to sliding mortgage applications. So clearly something's going on in the US housing market. And clearly one needs to be a little bit careful of US house builders. I don't know if people recall, but at the start of the pandemic, one of the issues was a lot of people owned several properties that they let out on Airbnb, and that was the business. And of course, Airbnb lettings came to a grinding halt with the first lockdowns. And a lot of these operators who had several properties got themselves into quite severe financial difficulty as a consequence of it. This is a very interesting chart because this shows that there's a huge density in certain areas. This is showing Los Angeles of Airbnb properties that are only used for Airbnb rental. And these are geared properties, and the occupancy and therefore the mortgage repayments is entirely dependent upon them being let. And if there is a US recession, there is going to be a reduction in occupancy of Airbnb properties, one would imagine. And that could make this element of the US property market very vulnerable to quite significant valuation issues. So, the US housing market is strong. We have house price inflation of 20%. They're selling quickly, they're selling more than the asking price, but there are indications that the affordability has affected demand, and that there is a fairly large change occurring in the property market, US housing market. I think particularly the mortgage originations is concerning, and that we may well find that the US housing market conditions change quickly.
Thank you, Richard. Okay, on to other charts. Okay, so thank you to Matt from our Discord for sending me this. Just shows the headwinds that emerging markets are facing. So we've covered many times, including last week, rising food inflation, rising oil prices, and as a result, the spread of EM bonds over treasuries is elevated, and a growing number of countries are classed as being in distress. So I expect that to get worse as food price inflation really kicks in later in the year, particularly when Ukraine misses this growing season and the lack of wheat supplies from Ukraine and Russia really start to bite.
Apparently, it's also a poor growing season in any event. So that is another addition to the potential global food shortage.
Oh dear. And these are the IMF forecasts for advanced and emerging economies, and this is relative to trend. So this is relative to the GDP pathway you would have expected pre-pandemic. And so what it's showing is that advanced economies will recover to their pre-pandemic pathways over the next few years, but emerging economies and low-income economies will suffer persistent scarring. So again, not very helpful for emerging markets. And as a result, a fifth of emerging market sovereign bonds are essentially in distress territory. Now, the market is also starting to price in ECB rate rises, and not small ones. So you're seeing that the market is expecting that over the next couple of years, the ECB will raise rates to around 2%. Frankly, I think the market is smoking the strong stuff. And this is the price of Eurozone corporate bonds, which have had a huge sell-off. So I'm surprised that European equities haven't suffered from a similar size sell-off. And economists have been slashing their GDP growth forecast for the Eurozone, although they still remain actually pretty solidly positive for this year. What's that, about 2.6%?
Yeah.
This is a chart showing the number of flights operated in China, and it's for up to the end of Q1. And it shows that lockdowns have essentially reduced the number of flights to their pandemic lows. And if we extrapolate that to economic activity in general, it paints rather a pessimistic picture of the Chinese economy. Okay, Richard, equity markets.
Thank you, Keith. So since we recorded last week, there's been a big sell-off, which happened actually shortly after. I think it happened while we were recording even. And then markets have, to a significant extent, recovered this week. So the FTSE almost unchanged. FTSE All Share almost unchanged for the year to date. Stocks Europe is down 1.5% for the week. The S&P 500 is down 10% for the year and 2.5% on the week. And the Nasdaq, similar weekly move, but nearly not far off 20% down for the year, which is chunky. And the Hang Seng is down 10% for the year, up 2% for the week. The Topics is down just 0.3%. We know what's happening to the Japanese yen. And Bitcoin is not having a particularly pleasant time of it, down 2% this week, 14% for the year. The pound against the dollar is down significantly over the year to date, but also nearly 3% this week. And the US dollar index up 2% for the week. So there has been a flight to safety vis-a-vis the US dollar, and the dollar index is quite strong at the moment. So we have daily charts now for the S&P 500 and the Nasdaq Composite. If you look for Friday last week, you'll see that there was a steep drop. The FTSE All Share
bouncing back from a steep drop.
Yeah, and the Euro Stoxx 600 likewise steep drop in early March. The Hang Seng is just not happy. I mean, it's very closely linked to China. China is economically not in a great place at the moment. And the Japanese index is similarly volatile. So Bitcoin bouncing around at around about the 40,000 level. And the pound really not having a good time with it. Was there any particular catalyst for that, Keith?
UK retail sales were disappointing.
Yeah.
But actually, generally, it's just the reciprocal of a very strongly rising dollar. The next chart shows the dollar index, which is going through the roof. Essentially, the US is raising rates faster than anyone. And, people are running to the dollar. To be fair, though, UK base rates are 0.75% compared to 0.33% in the US. And higher rates in the UK are not providing any protection against sterling. Sorry,
no,
not providing any protection for sterling. And we're now seeing the effects of Brexit, I think.
We do. I'm always minded when you look at a slightly longer term chart. So the dollar index basically has been trading in a channel for the last 5 to 6 years, in a range even for the last 5 to 6 years, a big range, and it's at the top of the range now. And the question is it going to actually break out of it and go up to 105, 110 or whatever, or is it going to fall back into its range?
Yeah, and if you're an emerging market and you borrowed in US dollars, this is going to hurt.
Yeah. So this chart shows that the American Association of Individual Investors survey to be very negative. And so 27th of week ending 27th of April, only 16% bullish and 60% bearish. And the historical average is 38% bullish and 30% bearish. So we are at an extreme here. Now, people do say that when you're at the extremes of sentiment, you should do the opposite of whatever the sentiment is. And we appear to be at an extreme low of sentiment at the moment. So that might mean that the market is going to have a bounce. The problem with that, of course, that thesis, is that the market is so extended. And with interest rates rising, that is going to apply more pressure to stock prices. So, this time may not be the same.
But what this chart shows, Richard, is historically it has been a bullish signal.
This is the Andromeda Galaxy at low resolution.
So what this chart shows is the 6 months with forward return, the S&P 500, against the percentage bulls in the American Association of Individual Investors survey. And what it shows is when you get to these low levels of bullishness, actually the following 6 months are almost invariably quite good.
Very few negative readings in that box is what you're saying, Keith.
Yeah, in fact, there aren't any.
Well, I think there's one, isn't there?
It's
extreme right-hand side of the box.
Oh, yes. No, you're right. You are right. Yes, you're right.
But not very many at all.
Yeah.
That's interesting, yeah.
So, yes, everything's shit. You should buy.
So this is showing that every time the S&P falls year on year, it does something, cuts rates, starts QE, doesn't stop QE, whatever. And the S&P is down year on year. There's a Fed meeting next week. Are they going to continue with their policy of raising interest rates and stopping QE? Or will they do something because they do not want the S&P to fall?
It's going to be interesting.
Yeah.
See what they do.
And equity flows have not been good for the last few weeks, so investors have been moving out of the market. And I always struggle with these charts. I don't quite understand how they create them, because if I sell a share, someone else is buying it from me. But it must be some sort of analysis of, I don't know, is it private investors?
People are putting money into ETFs, but you're absolutely right, Richard. So, you put like 10 grand into an ETF, the ETF goes and buys shares in the market, but somebody else must have sold them the shares. So net, yeah, I don't know.
That's why I don't understand these charts, Keith. From the start of the pandemic up until the end of 2020, these tech stocks went up, doubled, roughly speaking. And because they were perceived to be providing a need that people had when they were locked down, and that they would be profitable as a consequence. And now people are no longer locked down. I suspect they're not particularly keen on sitting on their Peloton. And as we all know, everyone's garage is full of gym equipment that they bought in hope and have never used. So, this is a sort of more of an indication that the NASDAQ is slowly coming back to earth, isn't it?
The P premium for the FANGs is declining. So essentially, investors are just no longer willing to grant the FANGs a big P ratio premium over the rest of the market. And that is what is causing the decline in FANG share prices, rather than, missed earnings beats, etc. And
S&P 500 earnings per share growth is back to normal levels of growth. So quarter one, it's at 7%, and there's enormous levels for the post-lockdown earnings per share growth, reflecting also the steeply negative growth that we had before. And short duration stocks are outperforming long duration stocks. As it says at the top, another Portfolio Matters prediction comes good. Well done, Keith. And the outperformance is enormous.
Yeah. So, we've been saying ever since we started this podcast, sell tech as interest rates rise, and they'll underperform. And that's exactly what's happened.
The New York Stock Exchange FANG Plus, that's a tech index, is down 20% in 3 weeks. And tech fundamentals, so what we've got here is aggregate price to free cash flow in blue, and free cash flow growth in red. And free cash flow is now negative. Growth is negative. In other words, it's gone into reverse. But the price to free cash flow hasn't yet started falling. In fact, it's continued to rise. So at some point, one would expect that blue line to start descending. And a peak ESG. So did you see that HSBC are having their knuckles rapped by the Advertising Standards Authority for claiming on a bus adverts that they are an ESG company. When I think they're not. And have we got peak ESG? Well, I mean, one would think that slowly people are starting to realize that ESG is not something that is easily doable, and that it's going to take many years for this to happen.
Well, we like ESG on this podcast, Richard, because they have been squashing supply without affecting demand, which is great for energy prices. So, long live ESG. Carry on with what you're doing.
Agreed, Keith. Stablecoin supply continues to grow.
So we know that like Tether is meant to have like $60 billion of assets or something to back its stablecoin, but it's never allowed an audit. So, I think these are another symptom of the Ponzi nature of crypto, frankly.
I think quite a lot of crypto may well be Ponzi in nature, but I don't think you should throw out the baby with the bathwater, Keith.
Really?
So I think some of it will survive, and but I think a lot of it is rubbish.
We will revisit this argument in about a year's time, Richard. How many have you still got some Ethereum and Bitcoin?
Yeah, hanging in by my fingertips. Yeah. Commodities. Commodity producer free cash flow. I mean, it's increased threefold since 2004, and it has increased actually sixfold since 2019.
Okay, so on to energy commodities. Thank you, Richard. Right, so this week, oil prices went up despite a general sell-off in markets, and particularly in commodity markets, which is interesting. So Brent was up 1.2%, WTI up 3.3%, but the other commodities, energy commodities, sold off with the market. So Dutch natural gas futures bounced hard when Russia announced it was going to cut off gas supplies to Poland and Bulgaria, but then fell back again and ended down 7.6% on the week. Coal drifted off 1.5%, although it's still up 92% in the last 4 months. Uranium had a bad week, down 14%, but up 21% on the week. Now, moving on to numbers relevant to the oil market. So total US crude inventories, including the SPR, fell by 2 million barrels last week. So that's saying that US is not getting all the oil supply it needs and is running through 2 million barrels of inventory in total last week. But we look at just the private sector inventories, they grew by 700,000 barrels, i.e. releases from the Strategic Petroleum Reserve are sufficient to keep the private sector fully supplied with oil currently. US crude production was unchanged at 11,900,000 barrels. That's only up 100,000 barrels on the year so far. So the US is not really reacting to very high oil prices and increasing its supply. And the Baker Hughes rig count ticked up 1. So this is crude, and that seems to be resuming its upward trend. And you'll all know that oil and gas companies are making absolutely enormous profits currently. Releases from the Strategic Petroleum Reserve are going to be enormous compared to previous releases. So in the second Iraq War, the SPR release was 17 million barrels. And there have been other releases when there was tight oil markets and Libya came offline due to civil war. That was 30 million barrels. Now we're going to release 180 million barrels. So that is by far the largest SPR release on record. And the US is then going to have to replenish at some stage.
Yeah.
Okay, so this is a piece of original research from Portfolio Matters, and this is from my personal spreadsheet that I keep of the US shale and the EIA's forecasts each month for each shale region. Now, in March, the way to read this table is in March, the first column is the EIA's estimates of oil production from each region. So they were saying that during March, at the Anadarko shale region would produce 399,000 barrels of oil per day. And they were forecasting that in April, that would increase to 405,000 barrels. But actually, the April number came in at 398,000 barrels. So they're forecasting that production would rise by 6,000 barrels a day. It fell by 1,000 barrels a day. And so in aggregate, they were forecasting that US shale oil production would rise in April by 117,000 barrels a day. In fact, it fell by 64,000 barrels a day, according to their data. So their error was an absolutely enormous 181,000 barrels a day. So rather than growing, the EIA numbers are actually portraying a picture of the US shale actually falling, production actually falling. That's really interesting and bullish for oil prices.
Mm.
And last week we talked about how Russia was struggling to maintain its oil output now that all the Western oil companies have left. And last week, Bloomberg were reporting that Russian oil production had fallen to around 10 million barrels a day from its previous levels of 11.5 million. Well, Reuters reporting that the Russian oil ministry is forecasting that production will fall by as much as 17% by the end of 2022 to reach around anywhere between 8.7 and 9.5 million barrels. So, not good. These are US distillate fuel stocks, which keep on falling because there ain't enough refining capacity. And that's bad. That means diesel and gasoline prices are likely to keep on rising, but also that refiners are going to make big profits. And these are Dutch natural gas futures. Reminder, they are still 4 times where they were last year, although they have come off a long way from their peaks. Now, these are forecasts for LNG demand. That's the solid black line. And the dotted line is the required capacity, whereas under construction, excluding Russia, is well below that line. So these forecasts from Bank of America essentially mean that they're expecting the LNG market to remain very tight. In the UK, we are now actually oversupplied. So you'll see that the price of gas in Europe compared to the UK, there's a huge differential. European gas prices are now 50% higher than UK ones because we've now entered the spring and summer season where gas demand is falling, and the UK has LNG terminals, whereas Europe doesn't have enough. Now, there is an interconnector, but it's full. So we are exporting gas to Europe. We can't export enough to reduce this differential. This is the coal price. It came off a tiny bit last week, but still very high. Amazing rises on the year. And coal demand is on the rise again, sadly. And reminder, coal is the world's main fuel for power. So this is global electricity supply by source. It's only to 2020, but look, the big black nasty section at the bottom is coal. And this dashed path is, we have to get to zero coal use by 2040, which would mean cutting our coal usage by 13% every year till 2030, whereas actually Chinese coal consumption is still growing strongly. And we covered last week how they're planning to increase coal production this year. We're doomed. And that's uranium. Big fall this week. Trading Economics had quite a poor explanation. They're basically just saying it had come off in line with concerns about global economic growth and other commodities.
Industrial commodities. All commodities got hit last week. Big fall for aluminium, 7%. Big fall for copper at 85%. And large fall iron ore, nearly 6%, lithium carbonate down 2.7%, magnesium 2%, nickel down 2.8%, tin down 7%, ferrovanadium down 8%, and zinc down nearly 7%. So apart from magnesium, they're all still up or neutral on the year. But last week, over the last week, commodity prices across the board have taken a hit. So we have aluminium, cobalt, unchanged.
Yeah, question marks about the timeliness of the data here, frankly.
Yeah. Copper and copper production is disappointing in both Chile and in Peru, and we do know that there is this projected shortfall in copper that is still persistent. So I think we've got short-term movement in the commodity, but long-term, I think the position is still quite bullish. Chromium, iron ore. You would say iron ore must be affected by the lockdowns in China. Lithium, just coming off slightly. Magnesium, neodymium, nickel, which is probably going to continue to move up, I suspect.
It's very elevated levels, though.
Yeah, true. Tin, which has, it's given back 20% in the last month. And ferrovanadium. I was reading the ferroalloy report this morning quickly, and it did state that the usage of vanadium in steel manufacturing is going up. So as we've discussed previously, 1% vanadium doubles the strength of steel, and clearly that makes it you need much less steel if you dope it with 1% vanadium. So economically, it makes a great deal of sense, which suggests that demand for vanadium is going to continue to rise. And zinc. Precious metals had a bad week. Gold down 2%, silver 4.5%, platinum 4%, rhodium 3%, and palladium 8%. Bad week for all of them. So there's gold. And silver. Platinum. Rhodium. And palladium.
Very disappointing. You'd think that, big sell-off in the market, investors rushing to safe havens, but actually the opposite. It's gold is a risk asset. They've been selling it. Very disappointing.
It's difficult to fathom, isn't it? Yeah, I agree.
Okay, on to rates. Well, as equity markets sold off, there was a flight to safety. And believe it or not, UK government bonds, gilts, are still considered a safe haven. So the yield curve fell. So all the bond yields in the UK were down on last week, but the UK 30-year now around 2%. And yields are still big up on the year. Now, in the periphery of the Eurozone, interesting, there was no flight to safety. In fact, they continued to sell off. So the Greek 10-year rose on the week by about 25 basis points. That's not small. And the Italian 10-year rose by 10 basis points. So something to watch as we go into the summer, and the ECB potentially stops QE and starts to think about raising rates. And because of the rise in inflation, bond yields are actually increasingly negative despite the fact they're rising. So bonds don't look like a good investment, as we have covered many times. So this is the UK 10-year. Despite a fall this week, that's still, the upwards trend looks very much intact currently.
It does.
Is the US, where it looks even more intact. And finally, onto the seasonality chart. And after a few gyrations, we're now expecting a big rise in May. Fingers crossed. Richard, what have you been up to this week?
Thank you, Keith. Well, I haven't been up to very much, actually. I've sat on my hands as ever. I had a so-so week, down 0.4%. And could have been a lot worse, actually, given the move in commodities. Changed the year 8.2%, and my relative performance 8.7%. No buys and no sales. So I just thought I'd review the cannabis chart. So this is pure cannabis ETF, which viewers will remember I've been watching for ages now, and waiting for it to break out of that trend channel, and it's not doing so. So still watching it.
It's a weed, Richard. You can just grow it in your garden.
I just thought it'd be interesting to have a look at the uranium ETF, because we saw that uranium was down 14% on the week. Uranium ETF was bashed around a bit. It was actually, from this point to this point, it then retraced virtually 100%. And from here to here, it has retraced to the 618 Fibonacci level. And I just think that's curious. Is it now going to, depends what happens to the price of uranium, of course, but are we now going to see a bounce back up to this sort of a level? Wheat is doing this interesting consolidation thing in its, and oil has got the same, a similar triangle. And the chartist will tell you that if you have a triangle and the price breaks up or down above or below the triangle, then there's likely to be a continuous move in that direction. So my suspicion is that we're going to break out of this triangle to the upside at some point. And then we have agricultural commodities, which is showing, I mean, that you could draw a triangle from here, but I just wanted to put this trend line in. They are sort of back on, or nearly back at the trend line. We know there's a huge amount of pressure on agricultural commodities coming up over the next 12 months. And the question is, to my mind, if and when they break out above that 2,900 level. This is the Bloomberg commodity ETF, agricultural commodity ETF. So, and that's all I have to say this week, Keith. How about you?
Thank you, Richard. Well, I had an indifferent week, down 0.8%, but it was a lot worse than that earlier in the week. I think I was down 5% at one stage.
Really?
So that takes me to up 19.9% on the year, beating the all share. Very nice. Okay, so I had a limit order in Occidental Petroleum, which got hit first thing last Friday morning before the sell-off. That was nice. So I got $62 a share, and it subsequently collapsed by about $8 or something. So anyway, I made a gain of 39% on that, and very nice. And then I did some spivving, because all these commodity stocks sold off hard. And I noticed that Anglo American was down 20% from its recent peak. So to get back to its peak, you're talking about 25% return. I thought, all the sentiment looks awful, bullish sign. I'll buy some. So I went in quite hard, actually. I bought, so regular viewers will know I had 10% in cash. So I bought a load of Anglo American with a 3.3% weighting for the portfolio, which is, go from 0 to 3.3 is a big move for me. I also added to my positions in BHP and Glencore, which I'd actually been selling off slowly over the last couple of months. So, and then I added to my Flex LNG position. So go through some charts. Well, I thought this was interesting. So various of my acquaintances and friends who are not invested in the stock market have been asking me what stocks to buy, because they're worried about inflation and they don't know anything about the stock market, and they want to buy stocks to protect themselves against inflation. And I wonder whether that effect is general and is supporting the market at the moment.
What is this a chart of, Keith?
Actually, I've got absolutely no idea. It was the comments at the top.
Yeah,
we're saying that. Yeah,
I think you're right. I mean, I think that people are only just beginning to appreciate that inflation is not transitory and it's nasty, and that commodities are, not only an inflation hedge, but actually the right commodities are going to be in short supply for a number of years going forward. So I suspect that we have yet to see the big private and probably institutional investors push into these assets. So I think, personally, I think it's worth holding on through the wild gyrations.
Yes, well, they've certainly recovered actually quite quickly. So let's take them. Oh, right. So the disaster of the week, and I did my worst trade on this briefly during the week, was Empyrean Energy, which was another wildcat driller. Regular viewers will know we had a disaster in a wildcat driller, Advanced Energy, in January. And my plan was to sell out of Empyrean before the drill results came in. Spoiler alert, you can go and watch the video. I failed. I only sold part of it before the drill result came in really early. And instead of taking 25 days, they drilled it in 17. So there was I sitting on my hands thinking I've still got a week left. Kaboom. Now, your other thing to notice about this chart is this section here is performance over the day before. Insiders drove the share price down by 25%. I have written to the FCA pointing out the blatant insider trading and prediction, fuck all will happen. But I did it anyway.
You've got to try, Keith.
Yep. Now, Serica Energy, BP sold its remaining 5% stake in Serica, and that drove down the price by 10%. This is Occidental. So I sold it here.
Yeah, well done.
This is Flex LNG. Well, I bought it 27.5, about here. BHP Billiton. So I bought it at 25.42, just there. Marvelous. Anglo, 32.2. I got pretty much the bottom. Marvelous. It's nice spivving when it works. So
well, Keith.
All those just, sold off, bought a bit more.
Yeah.
And that's it for this week. Let's hope we have a good May. In the seasonality chart predicts this is the strongest month of the year for markets. Anyway, thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.